April 1st, 2021. Canada's national debt reaches all-time high of $1.3 trillion. If every citizen of Canada got together to pay the debt, each of them would need to pay $36,000. Even if Canada's government stopped borrowing now, they would have a $30 billion expense every year in interest payments only. That would mean over $900 a second. So how does the government of Canada borrow money? Let's take the example of the $82 billion stimulus package issued by Justin Trudeau last year.
The measures we're announcing today will provide up to $27 billion in direct support to Canadian workers and businesses, plus $55 billion to meet liquidity needs of Canadian businesses.
When the virus arrived in Canada, federal spending was already over its budget. In fact, since 2008, Canada's government only repaid the national debt for 1 year. When the government needs money and they don't have enough to its yearly revenue, like this case, they issue bonds. Bonds issued by the Canadian government are called Canadian Treasury bonds. In a nutshell, the Treasury bond is a contract that obliges Canada to pay an interest rate to the lender every month until its maturity, where they pay back its face value. Face value is the price of the bond when it's issued by the government. Face value can change when the owner tries to trade it in the market depending on offer and demand. So, on a $1,000 treasury bond that matures in 5 years with a coupon of 5%, which is the interest rate paid to the lender, would mean that the bond buyer will receive $50 every year, $4.60 per month, and his initial investment of $1,000 after 5 years. If the investor is able to buy a bond under its initial value, they can boost its yield. For example, if an investor buys a bond with the initial face value of $1,000 with a coupon of 5% at $900, they are able to get a yearly return of 5.55%. Before the digital age, bonds were physical pieces of paper. But since computers existed, the government stopped issuing physical bonds. The last certificated physical bonds will come to maturity by June 2025. Usually, these fixed income investments are issued with a maturity of 2, 5, 10, or 30 years with a bigger coupon rate if the term is longer. These are the coupon rates today. Don't get fooled. A 0.23 yield on a 2-year bond means 0.23% per year of interest payments or 23 cents for every $100 invested. As you can see, they are not really attractive to buy. Buying at this rate would make the lender lose money just because of the average inflation of 2% a year. So who buys treasury bonds? Before the COVID-19 pandemic, buyers were investment firms, everyday individuals to pension funds, foreign government, and retail investors. Retail investors are regular people like you and me that invest our savings through brokers. A broker is a person or a software that buys and sells assets of others. Wealthsimple is a popular one in Canada. Like Canada, every foreign government had to increase spending to control the pandemic. So they can't fund other countries' debt anymore. A big buyer of the Canadian debt was China, but like us, their spending skyrocketed, thus they bought less Canadian bonds. Pension funds and investment firms are also not interested because they don't offer good return on investment. As for retail investors, they don't buy bonds either because the stocks are more profitable. So who buys treasury bonds? Basically, Canada buys their own debt. What, you may ask? Canada's government is able to do this using quantitative easing, or QE for short. This big word sounds complicated, but it's not. QE is when the central bank of a country prints money and uses it to buy large amounts of government bonds to add money supply in the economy. Since March 2020, according to the plan of Canada's central bank of buying $4 billion worth of bonds every week, they printed an approximative enormous amount of $244 billion, and the money supply grew almost 28% in the past 12 months because of it. So if Canada buys their own debt, who gets the interest payments? When the interest payments are due, Canada uses money earned by taxation, or they issue even more bonds to pay for the older bonds. Owing to the fact that the Bank of Canada owns those bonds, interest payments are given to them and is stored until they practice QE again. Therefore, that money just disappears from the economy. Many government officials suggest that last year's budget deficit was needed to stabilize and keep our economy healthy. But I think otherwise. I predict that in the next decade, we will see one of the worst cases of inflation ever seen in this country, where the housing market will be way too expensive for new home buyers, pension funds losing most of its value, and the gap between the working class and asset owners increasing. In the worst case scenario, Canada could experience hyperinflation like Zimbabwe in 2007. Like Canada's situation, the Mugabe regime printed too much money to finance military involvement and experienced a 79.6 billion% month-to-month inflation. Basically, the money became useless.